You wake up tomorrow morning, your bank account is frozen, the government just announced withdrawal limits, you can only access $250 of your own money per week. Your savings are trapped, your mortgage payment is due, and the cash in your wallet just lost a quarter of its purchasing power overnight. This scenario played out in Argentina in 2001. It happened in Greece in 2010. And right now, the same pattern is unfolding in the seventh largest economy on the planet. Brazil's currency hit an all-time low of 6.74 per dollar on December 26, 2024. The central bank's benchmark interest rate sits at 15%, the highest level since 2006. Government debt has climbed to 77.8% of GDP and rising. The nominal budget deficit reached 8.45% of GDP last year, roughly $155 billion in borrowed money. The Brazilian real lost 27% of its value in 2024. That made it the worst performing major currency in the world, worse than the Turkish lira, worse than the Mexican peso, worse than the Russian ruble. And if you think this stays contained to South America, you need to understand something. When Brazil's economy destabilized in 1998, it triggered a chain reaction that nearly collapsed a hedge fund so massive the U.S. Federal Reserve had to organize an emergency bailout to prevent a global financial meltdown. That fund was long-term capital management. The amount that almost broke the system? Exposure to just $125 billion in assets. Brazil's current debt obligations exceed $1.8 trillion. The pattern that destroyed retirement accounts from Buenos Aires to Athens is now repeating in Brasilia. The only difference this time is the scale. What I am about to show you is a pattern that has repeated 4 times in the past 25 years. Each time, economists said it was different. Each time, governments promised they had it under control. Each time, ordinary people lost everything while insiders moved their money to safety months in advance. I call this pattern the sovereign debt spiral. It operates in 4 distinct stages, and once you understand the mechanics, you will be able to see a crisis forming 6 to 12 months before the headlines catch up. Stage 1 is the spending trap. This is where governments become addicted to borrowed money. Spending rises faster than revenue. Deficits become structural. The political system rewards short-term promises over long-term stability. Stage 2 is the confidence crack. Markets do not crash on bad news. They crash when investors lose faith that the rules will hold. A single policy reversal, a single broken promise, and suddenly the cost of borrowing spikes. Stage 3 is the currency collapse. When foreign investors flee, they sell local currency to get out. The exchange rate does not decline gradually, it breaks. Import prices surge. Inflation accelerates. The central bank faces an impossible choice. Stage 4 is the doom loop. To defend the currency, the central bank raises interest rates. Higher rates increase the cost of servicing existing debt. Larger interest payments widen the deficit. The wider deficit requires more borrowing. More borrowing damages confidence further. The cycle feeds itself until something breaks. Argentina went through all 4 stages in 2001. Greece went through all 4 stages between 2010 and 2015. Turkey hit stages 1 through 3 in 2018. Brazil entered stage 1 in 2023. As of January 2025, it is now deep into stage 3 and showing early signs of stage 4. Let me walk you through exactly how each stage works, with the specific dates and numbers that reveal where Brazil stands right now. Stage 1, the spending trap. Think of a government like someone who just discovered balance transfers, move debt from one card to another, pay minimums, keep spending. The bills get paid, so everything feels fine. Brazil's federal government now spends more than 45% of GDP. Compare that to Mexico at 29% or Peru at 23%. This gap did not appear overnight. It built up over decades of pension commitments, social programs, and constitutional mandates that lock in spending regardless of revenue. Here's the number that matters. Mandatory spending now consumes 93% of Brazil's entire federal budget. A decade ago, that figure was 85%. The government has almost no flexibility. Before a single discretionary decision gets made, 93 cents of every dollar is already committed. In January 2023, President Lula returned to office for his 3rd term. Within months, his administration increased pension payments and expanded social programs. The political logic was straightforward. These policies are popular. They win votes. The problem? Tax revenue was flat. The government funded the expansion with borrowed money. In late 2016, Brazil had actually amended its constitution to cap spending growth at the inflation rate for 20 years. This was meant to restore fiscal discipline and rebuild market confidence. The framework lasted less than 5 years before being gutted. The Brazilian Senate, as independent fiscal institution, concluded in November 2024 that spending commitments under the Lula government would make the cap unsustainable in the medium term. When a country rewrites its own fiscal rules because following them is too hard, investors notice. Stage 2, the confidence crack. Continuing with stage 2, I need to cover the market confidence erosion, the fiscal target changes, and the divided central bank vote. I'll use the specific dates from my research. Markets do not punish governments for running deficits. Markets punish governments for changing the rules. April 15th, 2024. The Brazilian government officially revised its fiscal target for 2025. The original commitment was a primary surplus of 0.5% of GDP. The new target? 0. The real dropped 4% in a single day. Think about what that signals to someone who lent Brazil money. You were promised a surplus. Now you're told the goal is merely to break even. If they move the target once, what stops them from moving it again? 1 month later, the damage deepened. May 8th, 2024. Brazil's central bank held a monetary policy vote. For the first time in years, the committee split. The 4 members appointed by President Lula voted for a larger interest rate cut. The 5 members appointed by former President Bolsonaro voted for a smaller cut. The Lula appointees lost that vote, but investors understood the math. By 2025, Lula's appointees would hold the majority. The market began pricing in the end of central bank independence before it officially happened. Between late October and early January, the real lost nearly 15% of its value against the dollar. Brazil's main stock index, the Ibovespa, dropped 10% over the same period. In November, the government finally announced a fiscal control package. Markets had been waiting for aggressive spending cuts. Instead, they received modest measures with delayed implementation. The finance ministry projected savings of 330 billion reais over 5 years. Analysts called the numbers optimistic at best. Investors did not wait to see if the projections were accurate. They sold. Stage 3, the currency collapse. Now covering the currency collapse stage. I have good data on the real's depreciation, the exchange rate hitting record lows, and the central bank interventions. When confidence cracks, currencies do not decline in an orderly fashion. They break. On December 26, 2024, the Brazilian real hit 6.74 per dollar. That was the highest exchange rate in the currency's history. 12 months earlier, the rate was 4.86. A year before that, 5.22. To put this in concrete terms, if you held $1 million worth of Brazilian assets on January 1st, 2024, the real depreciated 27% against the dollar in 2024. For comparison, the Turkish lira fell 16.8%. The Mexican peso fell 15.3%. The Chilean peso fell 10.9%. Brazil's currency performed worse than all of them. The central bank tried to stop the bleeding. Between November and December, Brazil sold $30 billion from its foreign exchange reserves on the spot market to support the currency. The intervention bought time. It did not solve the problem. Here's the detail most analysis overlooks. Currency depreciation does not just hurt imports. It increases the real cost of existing debt. Brazil's external debt is projected to reach $2.286 trillion by the end of 2025. When the currency falls 27%, every dollar of that debt becomes 27% more expensive to service in local currency terms. The government collects taxes in reais. It owes money and obligations that just became massively more burdensome. The exchange rate closed 2024 at 6.18 per dollar. A decade earlier, it was 2.66. The real has lost more than half its value against the dollar in 10 years. Stage 4, the doom loop. Now covering the doom loop stage, the self-reinforcing cycle of high interest rates, rising debt service costs, and fiscal deterioration. This is where I bring together the 15% Selic rate, the interest payments consuming GDP, and the primary deficit situation. This is where the math turns brutal. When a currency collapses, inflation follows. Imported goods cost more. Energy prices rise. Food prices rise. The central bank has one primary tool to fight inflation: raise interest rates. In December 2024, Brazil's central bank hiked rates by 100 basis points in a single meeting. They signaled 2 more increases of the same size for January and March. The benchmark Selic rate climbed from 10.5% in May 2024 to 15% by mid-2025, where it remains today. 15%, the highest level since July 2006. Now follow the arithmetic. Brazil's debt-to-GDP ratio stands at 77.8% as of September 2025. At a 15% interest rate, that translates to roughly 11.7% of GDP going to interest payments alone, not paying down principal, just interest. Total government revenue in Brazil runs approximately 30% of GDP. That means nearly 40% of every tax dollar collected goes straight to debt service. The primary deficit, which excludes interest payments, has been negative for 5 consecutive months through September 2025. This number needs to be in surplus to stabilize debt levels. Instead, it keeps widening. February 2025 alone saw a primary deficit of 28.5 billion reais. Here is where the loop closes. The government borrows money to pay interest on existing debt. That new borrowing adds to the total debt. The larger debt requires larger interest payments next year. Larger interest payments require more borrowing. Each cycle makes the next cycle worse. The IMF's October 2024 report stated that Brazil would need a sustained and more ambitious fiscal effort to address public debt. The World Bank project's debt will rise to 82.5% of GDP by 2027 before any decline begins. The central bank cannot cut rates because inflation remains above target at 4.46% over 12 months. The government cannot cut spending because 93% of the budget is mandatory. The deficit cannot close because interest payments keep growing. Brazil is not approaching the doom loop. Brazil is in it. Now, before I show you the 3 historical crises that followed this exact pattern, take 1 second and hit subscribe. The next video in this series breaks down the specific assets that gained 50 to 200% during previous emerging market collapses and which positions to exit before the situation reaches its peak. What you're about to see next is the proof that this pattern is not speculation. It has happened before, and each time, the people who recognized it early protected themselves, while everyone else asked how they missed the warning signs. Argentina, 2001. The original sovereign collapse, December 3rd, 2001. Buenos Aires, Argentina. The government announced a policy called the Corralito. The name sounds almost playful. It means little corral in Spanish. What it meant in practice was that every Argentine citizen was now limited to withdrawing $250 per week from their own bank accounts. Imagine walking to your bank on a Monday morning. You have $50,000 in savings. You built that over 20 years. And now a government decree tells you that money is frozen. You can access it in small pieces on their schedule if they decide to let you. Middle-class families who had saved their entire lives could not pay their mortgages. Business owners could not make payroll. Retirees could not buy medication. The economic data behind this moment is striking. Argentina's debt-to-GDP ratio when it defaulted was 65%. That is lower than Brazil's current 77.8%. The country had been borrowing in dollars while collecting taxes in pesos. When confidence collapsed, there was no way out. Here is what most accounts leave out. When Argentina abandoned its dollar peg in January 2002, external debt jumped from 47% of gross national income to 125% overnight. The actual amount owed did not change. The currency collapse made every dollar of debt cost more than twice as much in local terms. GDP fell 19.9% between 1998 and 2002. Unemployment hit 21.5%. The poverty rate reached 57% of the population. 5 presidents cycled through office in 2 weeks. Riots erupted across the country. Protesters banged pots and pans in the streets of Buenos Aires in demonstrations called cacerolazos. But the damage did not stay inside Argentina's borders. The crisis triggered immediate contagion across Latin America. International investors did not distinguish between Argentina and its neighbors. They pulled capital from Brazil, Chile, and Mexico simultaneously. When panic hits, money runs for the exits. Argentina's default totaled roughly $100 billion across 152 different bond instruments. At the time, it was the largest sovereign default in history. Greece, 2010. The Eurozone near-death experience. Late 2009. Athens, Greece. A newly elected government conducted an audit of the national accounts. What they found changed European history. The previous government had reported a budget deficit of 6% of GDP. The actual number was 12.7%. Later revisions pushed it to 15.6%. Investors realized instantly they had been systematically misled for years. Bond yields spiked. Within months, the cost of insuring Greek debt reached $400,000 per $10 million of exposure. In May 2010, the IMF and the European Union assembled a bailout package of 110 billion euros. It was the largest rescue in recorded history at that time. Germany alone contributed 22 billion euros. The conditions attached to this money were severe: tax increases, pension cuts, public sector wage reductions. The retirement age went up, the minimum wage went down. Greece implemented the austerity, and the economy collapsed anyway. Real GDP per capita stood at approximately 22,600 euros in 2008. By 2014, it had fallen to 17,000 euros, a decline of 24.8%. The unemployment rate rose from 7.8% to 26.6%. Among young people, unemployment exceeded 60%. Here's the detail that rarely gets discussed. Most of the bailout money Greece received did not help Greek citizens. By early 2013, the EU and IMF had lent 290 billion euros, representing 65% of Greece's foreign-owed government debt. That money flowed through Greece and straight back out to European banks that had irresponsibly lent to Athens in the first place. French banks held $53.5 billion in Greek exposure. German banks held $36.8 billion. British banks held $12 billion. The bailout rescued those lenders. Greek citizens absorbed the cost through a decade of economic depression. Greece's GDP dropped 25% from pre-crisis levels. The economy was 1/4 smaller a decade later. More than 1/3 of the population fell near the poverty level. Household savings went from positive 9% to negative 9.7% as families spent down everything they had just to survive. An entire generation of educated Greeks fled to Germany and the United Kingdom. They never returned. The contagion spread immediately. Portugal, Ireland, Spain, and Italy all felt the pressure. Bond yields spiked across southern Europe. The crisis contributed to changes in government leadership in 9 different countries. The IMF later acknowledged it had underestimated the damage austerity would cause. In 2013, the organization issued what amounted to an apology for its handling of the Greek program. By then, the damage was permanent. Turkey, 2018, the 72-hour collapse. August 10th, 2018, Istanbul, Turkey. President Trump announced via Twitter that the United States would double tariffs on Turkish steel and aluminum. The stated reason was Turkey's detention of American pastor Andrew Brunson on espionage charges. By the end of that single trading day, the Turkish lira had crashed 20%. Store owners in Istanbul began repricing items hourly. A shirt that cost 100 lira in the morning might cost 120 lira by afternoon. Annual inflation reached 16% and kept climbing. The lira had already been weakening for months. Investors were concerned about Turkey's current account deficit, its reliance on foreign capital, and President Erdogan's public attacks on the central bank. Erdogan had called interest rates the mother and father of all evil, and pressured the monetary authority to keep rates low despite rising inflation. The tariff announcement was the match. The combustible conditions were already in place. Turkey's crisis was a classic currency and debt trap. Turkish corporations had borrowed heavily in dollars and euros because foreign interest rates were lower. They earned revenue in lira. When the lira crashed, their debts effectively doubled in local currency terms, even though the nominal amounts had not changed. By mid-2018, restructuring demands from corporations unable to service foreign currency debt totaled more than $20 billion. Banks that had driven the Istanbul Stock Exchange for years saw their share of market value drop from nearly half to less than 1/3. The central bank eventually raised rates sharply in September, but Erdogan continued to oppose orthodox monetary policy. The tension between political leadership and economic necessity became a defining feature of the crisis. What Turkey demonstrated was speed. From normal conditions to national emergency took 72 hours. The lira lost more than 40% of its value against the dollar over the course of 2018. A recession followed in 2019. Capital outflows during the August crisis alone reached $14.8 billion. Foreign investors did not wait to see if the situation would stabilize. They left. The Turkish economy had grown 7.4% in the first quarter of 2018. Erdogan pointed to this figure as proof of strength just weeks before the collapse. Growth rates mean nothing when the foundation is debt-fueled and confidence is fragile. 3 countries, 3 crises. The same pattern each time. Excessive borrowing created vulnerability. A loss of confidence triggered capital flight. Currency collapse made debts impossible to manage. Emergency measures came too late to prevent lasting damage. Argentina's debt to GDP ratio at default was 65%. Greece's crisis ignited at 127%. Turkey's currency broke with public debt at just 30% of GDP because the private sector carried the foreign currency exposure. Brazil's government debt stands at 77.8% of GDP. Its currency has already fallen further than the Turkish lira did in 2018. Its interest rates are at levels not seen in almost 2 decades. The indicators are not flashing warning signs. They are showing conditions that preceded collapse in every comparable case. January 2023. The foundation cracks. President Luiz Inácio Lula da Silva returns to office for his 3rd term. Within his first months, the administration increases social spending and begins publicly questioning the independence of Brazil's central bank. Lula had inherited a fiscal framework passed by Congress in August 2023. The rules were designed to put Brazil on a sustainable path by converting the primary deficit into a 1% surplus by 2026 and limiting spending growth thereafter. The commitment lasted less than a year. Non-interest spending began rising in line with GDP growth, faster than the inflation only increases the framework permitted. The drivers were healthcare, education, and social security expenditures. Politically popular, fiscally unsustainable. Brazil's debt-to-GDP ratio had climbed from just over 50% a decade earlier to the mid-70s. The trajectory was clear to anyone watching the numbers. April 2024, the first break. April 15th, 2024. The government officially revises its fiscal target for 2025. The original commitment, a primary surplus equal to 0.5% of GDP. The new target, 0. The Brazilian real dropped 4% in a single session. Investors had been told one thing. Now they were being told something different. The specific number mattered less than what the revision signaled about the government's willingness to honor its own commitments. This was the confidence crack, not a default, not a recession, simply a policy change that told markets the rules could shift whenever political convenience demanded. May 2024. The central bank fractures. May 8th, 2024. Brazil's Monetary Policy Committee, known as COPOM, holds a vote on interest rates. For the first time in years, the committee splits along political lines. 4 members appointed by President Lula vote for a larger rate cut to stimulate growth. 5 members appointed by former President Bolsonaro vote for a smaller cut to maintain inflation control. The orthodox faction won by a single vote, but the math was public. Everyone understood that by 2025, Lula's appointees would control the majority. Gabriel Galopolo, Lula's pick to lead the central bank in 2025, aligned with the orthodox board in later votes, attempting to signal continuity. Markets were not convinced. The institutional credibility that had taken years to build began eroding in real time. The central bank had been the one institution keeping investors relatively calm. That anchor was now visibly weakening. September 2024, the deficit widens. The nominal budget deficit for September alone hit a 102.2 billion reais. 1 year earlier, the September deficit was 53.8 billion reais. The gap had nearly doubled in 12 months. The primary balance, which excludes interest payments, had now been negative for 5 consecutive months. This figure needs to be in surplus to stabilize debt levels. Instead, it kept deteriorating. The IMF's October 2024 report on the Western Hemisphere noted that Brazil maintained solid growth and historically low unemployment, but warned that addressing public debt would require a sustained and more ambitious fiscal effort. The economy was growing, jobs were plentiful, and the government was still spending far beyond its means. November 2024. The package that failed markets had been waiting for a serious fiscal adjustment. Speculation centered on meaningful spending cuts, structural reforms, perhaps changes to the pension system that consumed a growing share of the budget. The government unveiled its fiscal control package in late November. The measures were modest. Implementation timelines stretched years into the future. The finance ministry projected savings of 330 billion reais over 5 years. Roughly 55 billion analysts immediately questioned the assumptions. Several sectors with special tax benefits opposed any limitations. The governing coalition was fragile. Enforcement looked uncertain. The Brazilian Senate, as independent fiscal institution, concluded that spending commitments already undertaken would make the fiscal cap unsustainable in the medium term. Markets did not wait for the projections to be tested. Between November 26th and December 30th, the dollar rose 7.2% against the real. The Ibovespa stock index dropped 7.4% over the same period. The fiscal package was supposed to restore confidence. It accelerated the sell-off instead. December 2024, the currency breaks December 18th, 2024. The central bank raises the Selic rate by 100 basis points in a single meeting, double what many analysts expected. The committee signals 2 additional hikes of the same magnitude for January and March, which would push rates from 12.25% to 14.25%. It was not enough. On December 26th, the real hit 6.74 per dollar, an all-time low. 12 months earlier, the rate was 4.86. The currency had lost more than 27% of its value in a single year. The central bank intervened directly, selling $30 billion in foreign exchange reserves on the spot market to stabilize the currency. The real closed the year at 6.18 per dollar, off its worst levels, but still far weaker than any point in Brazilian history. For context, during the COVID-19 panic in May 2020, the real briefly touched 5.90 per dollar. The December 2024 low exceeded that crisis point by 14%. 2025, the doom loop takes hold. The Selic rate reaches 15% by mid-2025 and stays there. The central bank holds steady for 4 consecutive meetings, citing persistent uncertainty and inflation that remains above the 4.5% tolerance ceiling. In September 2025, 12-month inflation runs at 5.17%, exceeding the upper band of the target. The central bank projects convergence to 3% by the second quarter of 2027, but markets remain skeptical. The Focus Bulletin, a weekly survey of financial institutions, shows inflation expectations for 2025 and 2026 stuck above target. GDP growth slows sharply. Real output expanded at an annualized 5.3% in the first quarter of 2025. By the second quarter, growth dropped to an annualized 1.5%. The central bank's economic activity index suggests the third quarter may show contraction. Government consumption and total investment both decline. Consumer spending moderates. Retail sales of motor vehicles, construction materials, and furniture all fall below year-ago levels. The primary deficit persists. The debt-to-GDP ratio climbs to 77.8% by September, up from 76.3% the previous quarter. Projections show it reaching 82.5% by 2027 before any stabilization begins. Interest payments consume more than 7% of GDP. Every rate hike designed to control inflation simultaneously increases the cost of servicing existing debt. The government borrows to pay interest. The borrowing adds to debt. The larger debt requires higher interest payments. The cycle continues. Where Brazil stands right now, the real has recovered partially from its December lows, trading around 5.4 per dollar as of late 2025. This 12% bounce from the worst levels has led some analysts to suggest the crisis is stabilizing. The underlying numbers tell a different story. The benchmark interest rate remains at 15% with no indication of cuts coming soon. The central bank explicitly states it will maintain current rates for a prolonged period and will not hesitate to resume hiking if conditions warrant. The nominal deficit over 12 months exceeds 1 trillion reais. The primary balance remains negative. Mandatory spending still consumes 93% of the budget. External debt is projected to reach $2,286 trillion. Government debt stands at $1.83 trillion. The fiscal framework that was supposed to restore discipline has been repeatedly weakened. Brazil enters 2026, an election year, with interest rates at 2-decade highs, growth decelerating, inflation above target, and a debt trajectory that every major institution describes as unsustainable without significant adjustment. The foreign policy analysis published in February 2025 framed the situation directly. What is happening in Brazil is not a typical emerging market crisis. The sovereign debt is mostly in local currency. Foreign reserves remain substantial, but the fiscal anchors have come unmoored, and the doom loop between deficits, interest rates, and debt service is now self-reinforcing. The pattern that destroyed Argentina, Greece, and Turkey is not approaching Brazil. It is already here. You might be watching this and thinking you have no exposure to Brazil. You do not own Brazilian stocks. You have never bought a Brazilian bond. Your retirement account is invested in American companies and maybe some European funds. Here is why that does not protect you. The contagion mechanism. When a major emerging market economy destabilizes, investors do not carefully analyze which countries are similar and which are different. They sell first and ask questions later. In 1998, Russia defaulted on $40 billion in domestic debt. That sounds like a contained problem. Russia's economy was smaller than Brazil's is today. The default should have been a regional issue. Instead, the Russian default triggered a global crisis. Emerging market bond spreads spiked worldwide. Capital fled from Asia, Latin America, and Eastern Europe simultaneously. A hedge fund called Long-Term Capital Management, which had bet heavily on bond market stability, lost $4.6 billion in less than 4 months. The Federal Reserve had to organize an emergency bailout, not because American banks had lent money to Russia, because the panic spreading through global markets threatened to freeze credit everywhere. Long-Term Capital Management had $125 billion in assets under management. Brazil's government debt alone exceeds $1.8 trillion. Currency contagion is already visible. When Brazil's real collapsed in late 2024, analysts immediately began watching Mexico, Colombia, Hungary, and Romania. These countries share a common vulnerability. They rely on foreign capital inflows. They run current account deficits. They have currencies that move sharply when global risk appetite shifts. The mechanism works like this. An international fund manager holds emerging market assets across multiple countries. Brazil starts falling. The fund experiences losses. Investors in the fund request redemptions. The manager needs to raise cash. They sell whatever is liquid, regardless of whether those other countries have problems of their own. Mexico did nothing wrong in December 2024. The Mexican peso still dropped as investors pulled money from Latin America broadly. If Brazil enters a full crisis requiring IMF intervention or debt restructuring, the selling pressure on every comparable economy intensifies. The probability of one country entering crisis increases the probability of the next one falling. Research on sovereign debt contagion shows that direct cross-country interactions amplify crisis transmission. Once one domino falls, the odds of subsequent dominoes falling rises with each collapse. Banking exposure reaches into your portfolio. European and American banks hold billions in Brazilian debt. When sovereign bonds lose value, bank balance sheets weaken. Weakened banks reduce lending. Reduced lending slows economic activity. Slower activity affects corporate earnings. Corporate earnings drive stock prices. The Greek crisis demonstrated this chain precisely. French banks held $53.5 billion in Greek exposure. German banks held $36.8 billion. The European bailout of Greece was structured primarily to prevent those losses from destabilizing the broader banking system. If you own a diversified stock fund that includes European financials, you have indirect exposure to Brazilian risk. If your pension holds bonds from international banks, the same applies. The connections are not always obvious. They become obvious after the losses appear. Trade disruption hits consumer prices. Brazil is one of the top 5 commodity exporters in the world. soybeans, coffee, iron ore, sugar, orange juice, beef. These products move through global supply chains and affect prices everywhere. If Brazil's economy enters severe recession, production disruptions follow. Farmers cannot access credit. Mining operations scale back. Export infrastructure deteriorates. Commodity prices do not stay regional. When Brazilian soybean exports decline, buyers turn to American farmers. Increased demand raises prices. Higher input costs flow through to food manufacturers, restaurants, and grocery stores. Your grocery bill is connected to the stability of Brazil's currency, whether you realize it or not. Political instability creates unpredictability. Brazil holds presidential elections in October 2026. Economic stress heading into that election raises the probability of populist outcomes, policy reversals, and institutional breakdown. Argentina cycled through 5 presidents in 2 weeks during its 2001 crisis. Greece saw multiple government collapses between 2010 and 2015. Turkey's crisis accelerated Erdogan's consolidation of power over economic institutions. Political chaos in the 7th largest economy on the planet does not stay contained. Trade negotiations stall. Investment agreements become uncertain. Regional security arrangements weaken. Brazil shares borders with 10 countries. Instability radiates outward through migration, trade disruption, and diplomatic friction. The feedback loop between markets. Here is what makes modern crises different from historical ones: speed. In 1997, the Asian financial crisis took months to spread from Thailand to Indonesia to South Korea. Information moved slowly, capital moved slowly. Investors had time to assess each situation individually. Today, algorithms execute trades in milliseconds. News travels instantly. A headline about Brazil at 9 a.m. reaches every trading desk on Earth before 9:01 a.m. Turkey's currency lost 20% in a single day in August 2018. The lira's collapse began affecting European bank stocks within hours. Contagion that once took weeks now takes minutes. If Brazil experiences a sharp discontinuity, a failed bond auction, an emergency currency intervention, a surprise political development, the reaction will not wait for careful analysis. The real risk is correlation. Diversification protects you when assets move independently. You own stocks and bonds because they often move in opposite directions. You own domestic and international investments because different economies face different conditions. Crisis breaks these correlations. When panic hits, everything sells together. Stocks fall, bonds of risky borrowers fall, emerging market currencies fall, commodities fall. The only assets that rise are those perceived as absolutely safe. U.S. Treasuries, the dollar, maybe gold. In 2008, diversification failed because every asset class was connected through the banking system. In a Brazil-triggered emerging market crisis, diversification fails because capital flight treats all risk assets as identical until proven otherwise. The foreign policy analysis from February 2025 made this point explicitly. What is happening in Brazil should serve as a warning for the rest of the world. The pattern of fiscal expansion, lost market confidence, currency pressure, and rising debt service costs is not unique to emerging markets. The United States runs persistent deficits. European countries routinely exceed their own fiscal rules. Japan's debt-to-GDP ratio exceeds 250%. Brazil is the warning shot. The question is whether anyone is paying attention. I can already hear 3 counter-arguments forming. These are the same objections analysts raised before Argentina collapsed, before Greece needed a bailout, before the Turkish lira went into freefall. Let me address each one directly. Objection 1, Brazil is too big to fail. International institutions will step in. This sounds reassuring. Brazil is the 7th largest economy in the world. Surely the IMF, the World Bank, and major trading partners would organize a rescue before things spiral out of control. Here's what that assumption misses. Bailouts do not prevent crises. They socialize the losses after the damage is done. Greece received the largest bailout in recorded history, 3 separate rescue packages totaling more than 290 billion euros. The result? GDP still fell 25%. Unemployment still hit 27%. The economy was still 1/4 smaller a decade later. The bailout money flowed through Greece and straight to the European banks that had made reckless loans. German and French taxpayers were not rescuing Greek citizens. They were rescuing their own financial institutions. Argentina received IMF support multiple times before its 2001 collapse. The final tranche was denied in December 2001, just weeks before the default. The institution that was supposed to provide a safety net pulled back at the exact moment Argentina needed it most. International rescue packages come with conditions: austerity measures, spending cuts, structural reforms. These conditions often deepen the recession in the short term while the political system destabilizes under public anger. Brazil's situation carries an additional complication. The debt is overwhelmingly denominated in local currency. This means a traditional balance of payments rescue is not the right tool. You cannot solve a fiscal crisis with foreign exchange reserves. If Brazil requests IMF assistance, it signals to markets that the government has lost the ability to manage its own finances. The announcement of negotiations often accelerates capital flight rather than calming it. Too big to fail does not mean too big to suffer. Objection 2. Central banks have sophisticated tools now. They can manage situations like this. This argument assumes that monetary policy can solve fiscal problems. It cannot. Brazil's central bank has already deployed its primary weapon. Interest rates sit at 15%, the highest level in nearly 2 decades. The Selic rate has been held steady for 4 consecutive meetings because inflation remains above target despite the economy slowing sharply. The central bank faces an impossible trade-off. If it cuts rates to support growth, inflation accelerates and the currency weakens further. If it keeps rates high to defend the currency, debt service costs keep rising and the economy contracts. There is no interest rate that solves a structural deficit. The other tool central banks use in currency crises is direct intervention. Brazil's central bank sold $30 billion in foreign exchange reserves during December 2024 to support the real. The currency still hit an all-time low. Reserves provide a buffer, not a solution. Brazil holds substantial foreign reserves, but burning through them to defend an unsustainable fiscal position simply delays the reckoning while depleting the cushion available for a genuine emergency. Turkey's central bank intervened repeatedly during its 2018 crisis. The lira still lost 40% of its value that year. Intervention works when markets believe the underlying fundamentals will improve. When they do not, intervention just transfers reserves to foreign investors exiting the country. The sophisticated tool that would actually help is fiscal adjustment, spending cuts, revenue increases, structural reform to mandatory expenditure categories. These are political decisions, not monetary ones. The central bank cannot force the legislature to reduce pension commitments. Gabriel Galopolo, the new central bank president appointed by Lula, has maintained orthodox policy stances in his early months. Markets remain skeptical because the institution's independence depends on continued political support. One change in that support and the credibility built over years evaporates overnight. Central banks are powerful within their domain. Their domain does not include fixing government budgets. Objection 3. Brazil's economy is fundamentally strong. GDP grew 3.4% in 2024. This is the most dangerous objection because it confuses activity with stability. Brazil did grow 3.4% in 2024. Unemployment fell to 6.2%, historically low by Brazilian standards. Consumer spending remained solid. These are real achievements. They are also irrelevant to the debt trajectory. GDP growth funded by borrowed money is not sustainable growth. It is a sugar high that makes the eventual crash worse. Think about it at a personal level. If you max out 5 credit cards to fund a lifestyle upgrade, your spending looks great. New car, new furniture, nice vacations. Your neighbors might think you are doing well. Your bank statements tell a different story. Brazil's nominal budget deficit reached 8.45% of GDP in 2024. That means for every dollar of economic activity, the government borrowed more than 8 cents beyond what it collected in revenue. Growth of 3.4% does not cover a deficit of 8.45%. The math does not balance. By the second quarter of 2025, GDP growth had already slowed to an annualized 1.5%. The central bank's economic activity index suggested the third quarter might show outright contraction. Retail sales weakened, investment declined, government consumption fell, the sugar high is fading, the credit card bills remain. Greece grew at 4.5% annually in the years before its crisis. Ireland was called the Celtic Tiger for its growth rates. Argentina was the darling of emerging market investors in the late 1990s. Turkey posted 7.4% growth in the first quarter of 2018, just months before its currency collapsed. Strong growth numbers before a crisis are not evidence of resilience. They are often evidence that borrowed money is masking structural weakness. The World Bank projects Brazil's growth will moderate to 2.4% in 2025. The economy is slowing precisely as debt service costs are rising. That combination is the definition of unsustainable. The common thread. All 3 objections share a single flaw. They assume someone else will solve the problem or that the problem is smaller than the evidence suggests. Bailouts transfer losses rather than preventing them. Central banks cannot fix fiscal deficits. Growth rates mean nothing if they are debt-fueled. The pattern repeats because these same objections get raised every time. Argentina's defenders said the currency board was solid. Greece's defenders said Eurozone membership provided protection. Turkey's defenders said the banking system was well capitalized. Each statement contained partial truth. None of them prevented the crisis. Brazil has foreign reserves. Brazil has a diversified economy. Brazil has a sophisticated financial system. All of these provide some cushion. None of them address the core problem. The government spends more than it collects. The gap is financed with debt. The debt grows faster than the economy. Interest payments consume an increasing share of revenue. The currency weakens. Interest rates rise. The debt grows faster still. Until this cycle breaks, the crisis continues, and the cycle does not break through hope, reassurance, or sophisticated monetary tools. It breaks through fiscal adjustment, or it breaks through default. There is no third option. You now understand the pattern. You have seen the historical proof. You know where Brazil stands in the sequence. The question that matters is what you do with this information. Here are 5 specific actions ranked by urgency. Each one includes a timeline and concrete steps. Action 1, audit your emerging market exposure. Timeline this week. Most investors have no idea how much emerging market risk sits inside their portfolios. It hides in target date retirement funds. It appears in diversified international allocations. It shows up in bond funds seeking higher yields. Pull up every fund you own. Check the holdings. Look for these categories. Emerging market equity funds. Tickers like EEM, VWO, or IEMG. These hold Brazilian stocks directly. Emerging market bond funds. These hold sovereign and corporate debt from countries including Brazil. The yields look attractive until the currency collapses and the bonds get repriced. Latin America regional funds. These concentrate exposure exactly where the risk is highest right now. Global funds with emerging market allocations. Even a fund focused on developed markets might hold 5 to 15% in emerging economies for diversification. Add up the total. If your emerging market exposure exceeds 10% of your portfolio, you are carrying meaningful risk to a Brazil-driven contagion event. The action is not necessarily to sell everything. The action is to know what you own before you read a headline that forces a decision under pressure. Action 2, reduce concentrated Latin American exposure. Timeline, before the end of March 2025. If your audit reveals significant Latin American holdings, reduce them by at least half. Brazil's central bank has signaled it will hold rates at 15% for an extended period. By April, the economic data from the first quarter will be published. If growth continues slowing while inflation remains above target, the doom loop becomes harder to deny. You do not want to be making selling decisions after that data prints. This applies to individual stocks as well as funds. Brazilian companies trading on U.S. exchanges as ADRs carry currency risk on top of business risk. A company can perform perfectly and still see its dollar-denominated share price fall 25% if the real weakens further. The real has already recovered partially from its December lows. The move from 6.74 to 5.40 per dollar might feel like the crisis is over. That recovery came with $30 billion in central bank intervention and the highest interest rates in 2 decades. Recoveries during structural crises are selling opportunities, not signs of safety. Action 3, currency hedge. Any international positions you keep. Timeline, implement within 60 days. If you cannot or will not reduce international exposure, hedge the currency risk. Currency-hedged ETFs exist for most major international equity categories. These funds use forward contracts to neutralize exchange rate movements. You get the stock market returns without the currency volatility. For Brazil specifically, the iShares MSCI Brazil ETF trades under the ticker EWZ. It is unhedged. When the real falls, your dollar returns fall, even if Brazilian stocks rise in local terms. There is no widely available currency-hedged Brazil fund for retail investors. This means direct Brazilian equity exposure carries unhedgeable currency risk for most people. That alone is a reason to reduce it. For broader emerging market exposure, currency-hedged options exist, but come with higher fees and tracking error. The cost of hedging is real, so is the cost of a 27% currency decline. The real could stabilize here. It could also resume its decline if fiscal conditions deteriorate further or if global risk appetite shifts. External debt projected at $2,286 trillion means continued pressure on the currency from debt service outflows. Action 4, increase allocation to dollar-denominated safe assets. Timeline, rebalance by June 2025. When emerging market crises hit, money flows to safety. Every time. The destination is predictable. U.S. Treasury bonds, the U.S. dollar, sometimes gold. You do not need to predict the exact timing of a crisis to benefit from this pattern. You need to own the assets that appreciate when fear spikes. If your portfolio is heavily weighted toward equities and corporate bonds, shift a portion into Treasury securities. The specific allocation depends on your risk tolerance. Aggressive investors move to 25 to 30% cash in Treasuries. Moderate investors move to 35 to 45% cash in Treasuries. Conservative investors move to 50% or higher. Yes, Treasury yields are lower than what you can earn in riskier assets. That is the price of insurance. You do not buy homeowners insurance hoping your house burns down. You buy it because the cost of being unprotected exceeds the premium. Short-term treasuries and money market funds currently yield above 4%. You are being paid to wait in safety. That was not true 3 years ago. The dollar strengthened throughout 2024 as global uncertainty rose. If Brazil's situation deteriorates further, or if contagion spreads to other emerging markets, the dollar likely strengthens again. Holding dollar-denominated assets means you benefit from that move rather than suffer from it. Action 5. Establish a monitoring system. Timeline set up this week. Review weekly. Crises announce themselves through specific indicators. If you know what to watch, you see the acceleration before the headlines catch up. Track these 4 data points every week. First, the USD-BRL exchange rate. The real closed 2024 at 6.18 per dollar after touching 6.74 at its worst. If the rate breaks above 650 again, stress is returning. If it breaks 7 taus, crisis conditions are imminent. Second, Brazilian 10-year bond yields. These currently sit around 15%, matching the policy rate. If yields spike above 17%, the market is pricing in serious default risk. Watch for divergence between shorter and longer maturities as well. Third, credit default swap spreads on Brazilian sovereign debt. This is the cost to insure against a Brazilian government default. During Greece's crisis, CDS spreads hit $400,000 per $10 million of exposure. Current Brazilian spreads are elevated but not extreme. A sharp spike signals institutional investors are buying protection. Fourth, central bank foreign exchange reserves. Brazil sold $30 billion in December to defend the currency. If reserve drawdowns accelerate, the ammunition is running low. Watch monthly central bank reports for the reserve position. Set up a simple spreadsheet. Record these numbers every Friday. After a month, you will see trends that daily news coverage misses. Additionally, create Google alerts for these phrases: Brazil IMF, Brazil fiscal crisis, Brazil debt restructuring, and Brazil capital controls. You want to know the moment serious institutional intervention enters the conversation. Timing matters. The difference between investors who get hurt in crises and investors who avoid losses usually comes down to 6 months. 6 months before Argentina's default, the warning signs were visible. Deposits were leaving the banking system. The currency peg was under pressure. Bond yields were spiking. 6 months before Greece's bailout, the revised deficit numbers were public. Rating agencies were downgrading. Spreads were widening. 6 months before Turkey's collapse, the lira was already weakening. Corporate debt restructuring had begun. Erdogan's attacks on the central bank were escalating. In each case, investors who acted on early signals preserved capital. Investors who waited for confirmation sold at the worst levels or could not sell at all. Brazil's warning signs have been visible since April 2024. The fiscal target revision, the split central bank vote, the currency hitting record lows, the interest rate hiking to 15%. We are not 6 months before the warning signs. We are 12 months into them. The 2026 presidential election creates a hard deadline. Political uncertainty will intensify throughout the year. Fiscal adjustment becomes nearly impossible once campaign season begins. Any resolution, positive or negative, likely occurs before October 2026. That gives you roughly 20 months to position accordingly. The first 6 months of that window are the easiest. Liquidity is still available. Prices have not fully adjusted. Exits remain orderly. The last 6 months will not be orderly if conditions continue deteriorating. What this is not. This is not a recommendation to panic. Panic selling at market bottoms destroys wealth. This is not a prediction of imminent collapse. Brazil could muddle through for years. Crises often take longer to arrive than analysts expect. This is not financial advice tailored to your specific situation. Your age, income, obligations, and goals determine the right allocation. A 30-year-old accumulating assets faces different trade-offs than a 65-year-old living on a portfolio. This is a framework for thinking about tail risk. The probability of a severe Brazil crisis may be 20% or 30%. That is not a certainty. It is also not a rounding error. If there were a 25% chance your house would burn down next year, you would buy insurance, check your smoke detectors, and keep important documents in a fireproof safe. You would not ignore the risk because it was not guaranteed to happen. Apply the same logic to your portfolio. The cost of preparation, if the crisis does not materialize, is modest. Slightly lower returns from holding more safe assets. Some transaction costs from rebalancing. The cost of no preparation, if the crisis does materialize, is severe. Double-digit percentage losses. Forced selling at the worst moment. Years of recovery time. Asymmetric risks deserve asymmetric attention. Let me walk you through what the next 18 months likely look like based on the pattern and the current data. This is where we are right now. Official statements emphasize resilience. GDP grew 3.4% last year. Unemployment remains historically low. The currency has recovered from its December lows. Interest rates are high but stable. The finance ministry maintains that the fiscal package will deliver projected savings. The central bank signals confidence in inflation convergence by 2027. Political leaders dismiss market concerns as speculation or foreign interference. International coverage remains limited. Brazil does not lead news cycles in New York or London. Investors focused on U.S. interest rates and European politics pay little attention. Beneath the surface, the numbers continue deteriorating. Primary deficits persist. Debt to GDP ratios climb. The doom loop compounds quietly in spreadsheets that most people never see. April through June. First quarter economic data publishes. GDP growth has already decelerated from 5.3% annualized in Q1 to 1.5% in Q2. If the third quarter data confirms contraction, the slowdown becomes undeniable. Retail sales weaken further. Investment declines. Consumer confidence surveys begin reflecting concern about inflation and job security despite low official unemployment. International institutions issue updated assessments. The IMF's spring meetings include discussions about Brazil's debt trajectory. The World Bank revises growth forecasts downward. Rating agencies place Brazil on watch for potential downgrade. Sophisticated institutional investors begin reducing exposure. Capital outflows that were steady become noticeable. The real tests its December lows again. The Finance Ministry announces additional measures. Markets greet them with skepticism based on the pattern established by the November 2024 package. July through September, winter in Brazil. Historically, a period of lower economic activity. If the real breaks 7 points of Zoro per dollar, psychological resistance shatters. Each subsequent decline comes faster as stop losses trigger and hedging demand increases. The central bank faces pressure to intervene more aggressively. Foreign exchange reserves decline. Each intervention provides temporary relief, but depletes the buffer available for genuine emergencies. Political tensions rise. The 2026 election campaign unofficially begins. Opposition candidates attack the government's economic management. The governing coalition fractures over spending priorities. International media coverage increases. Brazil appears in headlines alongside words like crisis, contagion risk, and emerging market turmoil. Corporate earnings reports from Brazilian companies show margin compression from high interest rates and currency volatility. ADRs, trading on U.S. exchanges, decline regardless of company-specific performance. October through December, 1 year before the presidential election, two paths diverge. Path 1. The government announces credible fiscal adjustment, meaningful spending cuts, structural reform to mandatory expenditure categories, a commitment backed by legislative action rather than projections. Markets stabilize. The real strengthens. Interest rates begin declining. The doom loop pauses. Brazil enters 2026 with reduced but manageable stress. This path requires political courage that has not been evident so far. It requires accepting short-term pain for long-term stability. It requires breaking promises made to constituencies that depend on government transfers. Path 2. The government doubles down on current policy. Fiscal adjustment remains modest. The primary deficit persists. Debt continues rising. The central bank either maintains 15% rates and crushes the economy or cuts rates and loses the currency. Neither choice produces a good outcome. Discussions about IMF engagement begin. The word restructuring enters analyst reports. Capital flight accelerates as the 2026 election uncertainty compounds the fiscal uncertainty. Brazil enters the election year in crisis conditions rather than recovering from them. The presidential election is scheduled for October. If Brazil follows path 2, the campaign unfolds against a backdrop of economic distress. Inflation erodes purchasing power. Unemployment rises from its historic lows. Public services deteriorate as interest payments crowd out discretionary spending. Populist appeals intensify. Candidates promise to break with orthodox policy, reject international conditions, protect Brazilian sovereignty from foreign creditors. The rhetoric that preceded crises in Argentina, Greece, and Turkey echoes through campaign rallies. Whoever wins inherits an economy with limited options. The adjustment that could have been gradual in 2024 or 2025 becomes severe by necessity. The social cost multiplies with each year of delay. The pattern suggests that markets will not wait for the election to resolve uncertainty. If path 2 is evident by mid-2026, the crisis accelerates before voters reach the polls. The next 12 months represent the window for low-cost preparation. Liquidity remains available. Markets function normally. You can rebalance without forced selling or wide bid-ask spreads. Transaction costs are minimal. After a crisis becomes obvious, these conditions change. Emerging market funds experience redemptions that force selling. Bid-ask spreads widen. The assets you want to sell find fewer buyers at prices you want to accept. The asymmetry is stark. Preparing early costs almost nothing if the crisis does not materialize. Preparing late costs significantly if it does. Every historical parallel I showed you earlier had a window exactly like this one. A period when the warning signs were visible, but the crisis had not yet arrived. A period when preparation was possible without panic. In Argentina, that window closed in November 2001. The Corralito was announced December 1st. In Greece, that window closed in late 2009. The revised deficit numbers were published in October. By spring 2010, the bailout was unavoidable. In Turkey, that window closed in July 2018. The lira had been weakening for months. The August collapse turned gradual decline into freefall. Brazil's window is open now. It will not stay open indefinitely. I started this video by describing a scenario where you wake up and your bank account is frozen. That happened to real people in Argentina. It happened to real people in Greece. It happened to real people in Turkey. They were not speculators. They were not wealthy elites. They were middle-class families who assumed the system would protect them. They kept their savings in local banks. They held assets denominated in local currency. They trusted that someone in charge would prevent catastrophe. The catastrophe came anyway. The people who preserved their wealth were not smarter. They were not connected. They simply paid attention to the pattern earlier and acted while action was still easy. You now have the same information they had, the same framework, the same historical examples, the same current data. The difference between the people who protect themselves and the people who suffer losses comes down to one decision. Do you act on what you know, or do you wait for certainty that arrives too late? Part 2 of this series drops in 72 hours. Here is what I'm covering. The 3 specific asset classes that gained between 50 and 200% during previous emerging market crises. Not theoretical suggestions. Historical performance during Argentina, Greece, and Turkey. What worked, what failed, and how to position for a repeat. Which global banks carry the largest exposure to Brazilian debt? Some institutions have disclosed their positions. Others have buried the details in footnotes. I will show you exactly where the risk concentrates and which financial stocks face the greatest danger. The one country positioned to absorb capital flight from Brazil, and how to invest there before the rotation becomes crowded. Geography, trade relationships, and institutional stability create a clear beneficiary. The opportunity exists now while attention focuses elsewhere. This is not speculation. This is the playbook that repeats every time an emerging market destabilizes. The mechanics are predictable. The beneficiaries are identifiable. The only variable is whether you position before or after the crowd figures it out. Subscribe now, turn on notifications. Do not miss part 2. In 2008, everyone said nobody saw the financial crisis coming. In 2010, everyone said the Greek situation was a surprise. In 2018, everyone said Turkey's collapse was sudden. None of that was true. The warning signs were visible for months, years in some cases. The data was public. The pattern was documented. The people who claimed surprise simply were not paying attention. Brazil's warning signs are visible right now. The debt to GDP ratio climbing quarter after quarter. The currency hitting record lows. The interest rates at 2-decade highs. The primary deficit persisting despite promises of adjustment. The fiscal anchors have come unmoored. The doom loop is operating in plain sight. The pattern that destroyed savings across 3 continents is repeating in the 7th largest economy on Earth. I have shown you the mechanics. I have shown you the history. I have shown you the current data point by point. You cannot say nobody told you. The only question left is simple. What are you going to do about it?